Welcome back to the week through the was. And look, before we even get into today's deep dive, I have to start with a massive apology.
Yeah, that was a bit of a disaster on our end.
It really was.
Yeah.
If you were hitting refresh on your feed yesterday,
hmm
tapping your screen and wondering where on earth we were, that is entirely on us.
Completely on us.
We had a catastrophic technical glitch. I'm talking about the kind of glitch where the recording doesn't just fail, it gets totally corrupted and just vanishes into the digital void.
Poof, gone.
Gone. But we are back, the backups are running, and we are making absolutely sure that does not happen again. So thank you for your patience and for sticking with us.
I mean, it happens, but honestly, looking back at the last 24 hours, the delay might have actually been a blessing in disguise.
You think so?
I do, yeah. It gave us an extra day to really sit with what has been, frankly, one of the most deceptive weeks in market history.
Deceptive is, I think that's the perfect word for it. Because if you're just a casual observer or you're just glancing at the price tickers on your phone while you're in line for coffee, you probably think absolutely nothing happened.
Right, it looks totally dead.
You see Bitcoin bouncing around, trapped between $66,000 and $70,000, and it feels like a snooze fest. It feels like we're just stuck in mud.
It looks like stagnation on the surface, absolutely. But that is exactly why we do this show. If you lift the hood, the actual machinery of the entire market is being completely rewired right now.
Right.
We aren't really seeing price movement, but we are seeing massive structural displacement.
And that is the mission for this deep dive.
Yeah.
We're going to look way past the boring price action. We're going to talk about a massive split opening up between U.S. and global investors, which is actually a little scary when you dig into the source material.
It is.
We've got a real crisis brewing for Bitcoin miners who are essentially completely underwater right now. And perhaps most surprisingly, the U.S. government is quietly rewriting the rules for stablecoins in a way that just changes the entire game.
It's the plumbing revolution we've been waiting for, just perfectly disguised as a really boring week of trading.
So let's unpack the stalemate first. Looking at the data from this past week, the price of Bitcoin is trapped. It is like it's in a straitjacket between 66 and 70K. Why can't we break out of this? Is it just exhaustion? Are the buyers just tired?
It's not really exhaustion. It's actually a classic liquidity vacuum.
Okay, liquidity varies.
Yeah. You have to remember, we started the week with President's Day in the United States. That means the U.S. equity markets were closed. And when you take U.S. commercial banking volume completely out of the equation, the market becomes incredibly fragile.
So I hear that term a lot, liquidity vacuum. Break that down for us. Is it like trying to fill a swimming pool with a garden hose instead of a fire hose?
That's a great analogy, yeah. When the banks are open, you have a fire hose of volume, right? You have deep pockets, big institutional trades happening all day.
Right.
But when they are closed, you're left with the garden hose. The market was essentially left to algorithmic selling. It became entirely mechanical. We saw momentum indicators like the MESCD just sitting in negative territory, and the volatility just totally collapsed.
So there just wasn't enough force to push the price up, so it drifted.
Exactly. But here is the fascinating part. While the price is stuck, the actual ownership of the asset is changing hands incredibly aggressively.
Right, this confused me in the notes. Who is actually selling and who is buying right now?
This is the classic whale versus retail battle. And right now, the little guy is capitulating.
Giving up.
Giving up. Retail investors, specifically those holding less than 10 Bitcoin, they are selling. They're just tired of the chop. They see the price going sideways, they get bored, or they get scared that it's going to drop, and they just exit.
Which feels very emotional. It feels like impatience.
It is entirely emotional. But look at the other side of that trade. You have the whales. These are wallets holding anywhere from 1,000 to 10,000 Bitcoin. In the last month alone, that specific cohort added over 90,000 Bitcoin to their stacks.
90,000 Bitcoin. What is that? Something like $6 billion, roughly?
Give or take, yeah. So retail gets bored and sells, and the whales just quietly scoop it up without even moving the price. It is a massive transfer of wealth from the impatient to the patient.
Wow.
But the divide isn't just about wallet size, it is geographic. This is what I'm calling the Great Divide.
The Transatlantic Split. This really jumped out at me in the source material. It seems like the U.S. is running for the exits, but the rest of the world is, doubling down?
That is exactly the story right now.
Yeah.
U.S.-based ETFs, particularly the giants like BlackRock and Fidelity, they saw hundreds of millions of dollars in outflows this past week.
Just bleeding cash.
Just bleeding. On one day alone, we saw over 100 million leave U.S. spot ETFs. American investors are basically de-risking. They are worried about the Fed. They are worried about inflation. So they are treating Bitcoin like a high-growth tech stock and selling it to raise cash.
But meanwhile, looking at the data from Europe and the Middle East, it's a totally different vibe.
Completely different. Germany, Switzerland, Canada, they are all accumulating. And the really big one is the UAE. The United Arab Emirates now holds over $900 million in Bitcoin exposure via ETFs.
900 million. That is not small change. That's sovereign-level money right there.
It absolutely is. And think about the signal that sends. While U.S. retail investors are panicked about interest rates, sovereign wealth funds in the Middle East are treating this as a massive strategic accumulation window.
So they're buying our dips.
They are. They are using U.S.-regulated products like the American ETFs to buy the asset, but the capital is coming from abroad. The U.S. is basically selling the asset to the world and using its own financial infrastructure to do it.
That is a wild mental image. We are literally building the rails to sell our own digital assets to foreign governments. But I do want to push back a little on this idea that all smart money is buying.
Okay, let's hear it.
Because let's talk about Harvard. Usually when we hear the word endowment, we think smart money, right? But Harvard Management Company made a move this week that looked a whole lot like selling.
It did look like selling if you only read the headline. Harvard trimmed their Bitcoin ETF position by about 21%.
Right. So if I read that, my first thought is Harvard is bailing out. They see something in the macro environment that we don't.
And that would be the wrong take. They didn't cash out to U.S. dollars. They rebalanced. They took those profits and moved about $86.8 million directly into Ethereum, specifically the ETH ticker.
Into Ethereum. But isn't Ethereum generally considered a higher risk play than Bitcoin? Why would a highly conservative endowment do that?
Because they aren't viewing it as risk in the way a day trader does. They are viewing it as a diversification of use case.
Yeah.
This is modern portfolio theory playing out in real time.
So treating it like a standard asset class.
Exactly. They viewed Bitcoin as digital gold. It performed incredibly well. It hit its target weight in their portfolio, so they sold the top to lock in those gains. And they moved that capital into digital infrastructure, which is how institutional money views Ethereum. They aren't just blindly holding forever. They are actively managing a crypto portfolio.
That makes a lot of sense. It's less religious and more financial. They are just moving chips from the roulette table over to the blackjack table.
That's a good way to put it. It's a real sign of maturity. But while Harvard is out there playing 4D chess, some other proxy trades totally imploded this week. I saw you circled the news about Peter Thiel's Founders Fund and something called ETH.
Yeah, ETH.
Yeah.
Which, first of all, sounds like a straight-to-DVD monster movie. What actually happened there?
It was a horror movie for investors, that's for sure. ETHzilla was a stock that was supposed to act as a proxy for holding Ethereum. But it wasn't just holding the underlying coin, it was heavily leveraged.
Oh, boy.
Yeah. It was basically a massive bet on Ethereum using borrowed money.
And we know exactly how that ends when prices drop even a little bit. Leverage works both ways.
It ends in tears. The stock lost 97% of its value. Founders Fund liquidated their entire position. The trade is dead. But I really want to contrast that disaster with what a company like Hyperscale Data is doing right now.
What are they doing?
They aren't looking for leverage at all. They're looking for balance. They just announced they are buying physical silver, 100,000 ounces of it, to hold right alongside their Bitcoin.
Wait, physical silver, like actual heavy bars sitting in a vault.
Real physical silver bars. It's what they are calling a hybrid treasury. They are mixing the hyper volatility of crypto with the ultimate boring stability of a physical commodity. The market is screaming something at us here. We don't want leveraged bets like ETHzilla anymore. We want risk parity. We want stability.
It's growing up. The market is finally demanding adulthood.
It is.
And speaking of demanding environments, let's talk about the miners for a second. Because if I'm reading these reports right, mining Bitcoin right now is, well, it's a terrible business model.
It is currently a mathematically losing proposition for many of the operators out there. The average cost to produce one single Bitcoin for a public miner has hit $74,600.
Okay, stop right there. The cost to make it is $74.6K, but the actual price on the open market is hovering around $67,000. So every time they mine a coin, they're literally losing money.
They are running about an 8.3% deficit on every single block they solve. This is the definition of miner capitulation. These companies have massive electricity bills to pay. They have heavy debt to service on their hardware.
Right.
They cannot afford to sit on their hands and hold their Bitcoin. They have to sell it immediately into the open market just to keep the lights on. And that creates this massive, constant selling pressure that we're feeling on the price.
And it wasn't just the price dropping making things hard. Didn't the actual mining difficulty go absolutely haywire this week, too?
It did. It was a literal weather shock. We had those massive winter storms roll through the U.S. South recently. The miners had to shut down to save power for the local grids, which, by the way, they're often contractually obligated to do.
Right, demand response programs.
Exactly. But when the storms passed and they turned all those machines back on at once, the network difficulty spiked by 15%. That is the largest single difficulty increase in the history of the Bitcoin network. It jumped to 144.4 trillion.
15% harder to mine, basically overnight. That is brutal. So how does a company survive that? If you're losing money on every coin and it just got significantly harder to mine them, what do?
You pivot. And this is the most fascinating part of the week for me. Look at MRRA Holdings. They are one of the biggest miners out there. They didn't just go out and buy more mining rigs to compete. They acquired a majority stake in a company called Exion, which is directly linked to the French utility giant EDF.
And what does Exion actually do?
AI data centers.
Ah.
MRRA is realizing that mining crypto is just too volatile. But renting out high-end compute power for artificial intelligence, that is a steady, predictable cash flow. They are fundamentally transforming from Bitcoin miners into energy and compute infrastructure companies.
That is a massive structural shift. It's like they're finally acknowledging that just chasing the hash rate isn't enough anymore. You need a reliable side hustle, and AI is a pretty fantastic side hustle right now.
It's totally essential for their survival at this point. If the Bitcoin price stays flat for another 6 months, that AI revenue is what keeps the company alive.
Okay, let's shift gears to what you called earlier the plumbing revolution. Because while the miners are sweating and the price is crabbing sideways, the regulators in Washington seem to be surprisingly busy.
Very busy.
There was a rule change from the SEC this week that sounds incredibly boring on paper, the net capital rule, but you highlighted it as a total game changer. Why is that so important?
Because this is exactly the kind of news that gets buried on page 10 of the financial papers, but actually changes the world. Previously, if a registered broker-dealer or a bank wanted to hold stable coins, digital dollars, on their balance sheet, the SEC applied a 100% haircut.
Can you just quickly explain haircut in this context for us?
Sure. Imagine you are a major bank. If you hold $1 million in USDC on your books, the regulator comes in and says, we think this digital asset is extremely risky, so it counts as zero collateral. Yeah, so you effectively have to set aside another $1 million in actual fiat cash just to back it up. It made holding crypto incredibly expensive and wildly capital inefficient for Wall Street.
So it wasn't a ban, but it was a massive penalty, a huge deterrent.
Exactly. But the new guidance that just dropped changes that haircut from 100% down to 2%.
From 100% to 2%, that is night and day.
It is night and day. That effectively declares stablecoins to be cash equivalents in the eyes of the U.S. regulator. It means Wall Street trading desks can now use stablecoins to settle trades, move collateral around globally, and operate on-chain without completely destroying their balance sheet efficiency. It is the green light for massive institutional settlement.
That is huge.
Yep.
It basically integrates crypto dollars directly into the actual traditional banking system. And speaking of that integration, we saw some massive news about Stripe this week too, right?
We did. Stripe's recent acquisition, a company called Bridge, just received conditional approval for a national trust bank charter.
National bank charter. That sounds very official.
It is the absolute holy grail in finance. It means they aren't just a quirky tech company playing around with crypto anymore. They are becoming a federally regulated bank specifically designed for stablecoins. The U.S. government isn't banning stablecoins. They are nationalizing them. They are bringing them inside the federal tent.
So on one hand, we have the SEC making it incredibly cheap for banks to hold this stuff. And on the other, we have the OCC handing out actual bank charters to stablecoin issuers. It feels like the infrastructure is being poured concrete thick right now.
It really is. And don't forget the CME, the Chicago Mercantile Exchange. They announced they are moving to 24/7 trading starting in May of 2026.
Wall Street never sleeps.
Literally never sleeps anymore. And this entirely kills gap risk. You know how Bitcoin moves crazy on weekends when the traditional banks are closed?
Oh yeah, the Sunday scary dumps. I know them very well.
Right. Everyone in crypto knows them. But big traditional institutions hated that. because they couldn't hedge their positions on a Sunday afternoon if news broke. If the CME is open 24/7, that specific risk just vanishes. It makes Bitcoin a much, much safer asset for a boring, risk-averse pension fund to actually hold.
So the pipes are being connected all over the place. But let's step outside the financial plumbing for a second and look at the broader world stage, because we've got some serious geopolitical tension in the background right now, specifically between the U.S. and Iran. We saw the talks in Geneva. We have nuclear concerns.
Yeah.
Usually, the crypto enthusiasts tell me this is exactly when Bitcoin goes to the moon.
Yeah.
It's a safe haven, right? Buy insurance. Did that actually happen?
It absolutely did not. And this is a harsh reality check for the whole digital gold narrative.
What?
When the news hit about the escalating tensions in Geneva and the potential for military strikes, Bitcoin didn't rally, it fell.
It acted exactly like a tech stock.
It acted exactly like a high-risk tech stock. Investors got scared, and what do when they get scared? They sell liquid assets to raise cash. We have to be really honest about this. Even now, Bitcoin is still fundamentally a risk-on asset. When the world gets scary, big money runs to the U.S. dollar, not to Bitcoin.
That definitely breaks the heart of the maximalists, I'm sure. And then we also had the drama with the tariffs in the Supreme Court this week. Honestly, I feel like I need a law degree to follow half the news right now.
It was a chaotic sequence of events, to say the least. The Supreme Court ruled against the administration's broad usage of tariffs. They essentially said you can't just slap tariffs on everything under vague emergency powers.
So a big win for free trade.
In about an hour.
Oh.
Yeah. Then the administration turned around and signed a brand new executive order imposing a temporary 10% tariff anyway, just using a completely different legal justification.
Incredible. And how did Bitcoin react to that kind of legal whiplash?
It had a total knee-jerk rally. It shot up about 2% almost immediately and then just gave it all right back.
Typical.
Yeah, the market absolutely hates uncertainty. This policy volatility, where the fundamental rules of trade change from the Supreme Court to the White House in the span of a single afternoon,
Yep.
It just makes investors sit on their hands.
And sitting on their hands is exactly what they're doing with the Fed, too. We got the Fed minutes this week as well.
We did. Rates are holding steady right at that 3.5 to 3.75% mark. But the minutes themselves were a bit hawkish. Some members are still really worried about sticky inflation. And as long as those rates stay that high, it is mathematically expensive to hold Bitcoin.
Right.
You could be getting 4% risk-free in government bonds right now. Why take the massive risk on crypto? That opportunity cost is the heavy headwind keeping us trapped under $70,000.
Okay, let's leave the gloomy macro stuff behind for a minute and talk about the future, because there was some straight-up sci-fi level news in the tech stack this week. You mentioned AI agents having actual identities. Explain that to me like I'm a 5-year-old.
This is genuinely one of the most exciting developments that almost nobody in the mainstream is talking about. The Mantle Network just deployed a new standard called ERC 8004. Basically, it allows an AI agent, a piece of software, to have its own native on-chain identity and reputation.
So a bot can have its own wallet and a passport.
Effectively, yes. And when you combine that with this new protocol from dBridge, these AI agents can now swap tokens across completely different blockchains without a human ever being involved.
A true machine-to-machine economy.
Yes. Imagine an AI travel agent that lives on your phone. It books your flight, pays for it in USDC, autonomously swaps some of that into a loyalty token for the specific airline, and settles the entire transaction on-chain. We are rapidly moving from humans speculating on tokens to machines using tokens for actual global commerce.
That is completely wild. And while the machines are taking over, DeFi, decentralized finance, is trying to change its fundamental business model too. I saw Uniswap is currently voting on something called the fee switch.
Right. This is the core of the DeFi decoupling thesis. For years, crypto tokens were really just speculative casino chips. You bought them purely hoping the price went up. But Uniswap is voting to actually turn on protocol fees.
Meaning what? Dividends?
They don't call them dividends for very obvious legal and regulatory reasons, but functionally, yes. If you hold the Uniswap token, you get a programmatic cut of the trading fees generated by the platform. It turns the token from a pure speculation play into a real cash flow producing asset.
That changes the valuation model entirely. You can actually calculate a traditional PE ratio for a crypto token now.
Exactly. And that is exactly why we might finally see DeFi decouple from Bitcoin price action. If Bitcoin is stuck going sideways because of the Fed, but Uniswap is printing massive daily cash flow, investors might actually sell their Bitcoin to buy Uniswap. It's a classic Wall Street rotation into value.
Wow. Okay, so let's try to synthesize all of this for the week that was. We have a price that looks totally boring because of a massive stalemate between bleeding miners selling and whales quietly buying. We have the U.S. retail market selling while the UAE and Europe are buying. We have massive miners pivoting to become AI data centers. And we have the federal government basically building a 4-lane highway for stablecoins directly into Wall Street clearinghouses.
That is the perfect summary. It is a true maturation phase. It feels boring on the charts because the Wild West days are officially ending. The crazy volatility is actively being dampened by heavy regulation and deep institutional plumbing.
Which naturally brings us to the really big question. If we are integrating directly with the legacy banks, getting 2% haircuts from the SEC, trading 24/7 on the CME, and pivoting our hardware to run corporate AI, what actually happens to the soul of this whole thing?
And that is exactly the provocative thought I want to leave everyone with today. Remember, Bitcoin was created as a rebel currency. It was inherently anti-establishment. It was all about cypherpunks, total decentralization, and being your own bank.
The original ethos.
Right. But everything we saw this week proved that the actual path to $100,000 and beyond is purely through integration. It's through becoming a boring, highly regulated, standardized asset class.
The suits are finally here.
The suits are here, they're writing the federal rules, and they are buying the dip. So as we sit here and celebrate the plumbing revolution and the price stability, we really have to ask ourselves, are we saving Bitcoin or are we just domesticating it? Are we actively sacrificing the entire revolutionary ethos just to get a national bank charter?
Man, a heavy question to end a really heavy week. But that is exactly why we do this deep dive. Thank you so much for sticking with us through the technical glitches yesterday and wading through the dense news today. This has been the week that was.
Thanks for listening, everyone.
We'll catch you next time.